Hi, I'm Mike Cintolo, Chief Analyst of Cabot Growth Investor and Cabot Top 10 Trader. I'm here with your Cabot Weekly Review, recording this on late Friday morning, as usual, April 5th. So I had said this before, so early to mid-February through, say, late March, we did see some churning in the leaders. And then 2 weeks ago, we had a post-Fed meeting, last video I did, and we started to pop up, and it looked like, okay, I'm not expecting another 3 months up or anything crazy, but it looked like the pause that refreshes, so to speak. But that rally ran into a wall real quick. You can say it's because of interest rates or because of something else, but the fact is it did run into a wall. And now we're kind of back to where we were 2 or 3 weeks ago, which is, the market, some of the market, like the NASDAQ 100 coming in today, and a lot of leading stocks haven't really done much net over the last 2 months. Okay, there's been a lot of chopping, and there's been a lot of rally attempts during that period, gap up and stuff like that have been sold into. At the same time, we're not seeing a ton of abnormal action in those stocks. Maybe they nose below the 50-day a little bit, but they snap back. There's no real clear sign that Fidelity and T. Rowe Price are dumping everything, but there's no clear sign that they're really anxious to add to their positions, at least in some of these extended leaders, the ones that got going last November and December either. Now, it is still a stock-by-stock situation. Some of the fresher names, they have pulled back, don't get me wrong, but they were strong and, have pulled back to like their 25-day moving average. They still look okay. And of course, we had this rotation where there are a lot of, gold, oil, and even some just old world and general stocks, construction, stuff like that still look fine. So really my message right now is not so much, overall we're leaning bullish, but in terms of what to do now, it's really more just be flexible and sort of be prepared. Have your plan in place. Do you want to take some partial profits and ride through a potential correction in this stock? But this one over here, you don't have much profit. You want to set a tight stop. Which stocks do you want to buy if we ramp up from here? That sort of thing. It's really just more have your plan in place. It's been a couple months now where the character of the market, the bigger picture hasn't changed at all. And even the intermediate term hasn't changed that much. But there's been, like I said before, kind of a dimmer green light. And you just want to be prepared. We haven't had a pullback in 5 months, so nothing says the market can't pull back 5-6%, which could hit some of these stocks. But until that happens, you don't know if we're just kind of shaking the tree here and are ready to run as we kind of, are on the front edge of another earnings season coming up. So right now it's lean bullish, still holding my winners, but make sure you have a plan in place, have your stops in place, and have your buy list in place depending on what comes next. It's really about being flexible here. In Cabot Growth Investors Model Portfolio, the only moves we've done the last couple of weeks, we've taken a little bit of partial profit out of a couple of these extended leaders, but we're still holding positions in them, and we're aiming to give them some room if they do want to correct. So we're about 28% in cash, and we'll just take it from here. If the market ramps, I could put a lot of that to work pretty quickly. I see a lot of pretty decent ideas. But if things kind of continue to chop around, or if we do get some abnormal weakness, obviously the cash position will probably head higher from there, okay? All right, enough of the preamble. Let's get into the charts using a program called Market Surge. You can learn more at marketsurge.com. I think it's a product of Investors Business Daily. It's like the new Market Smith. They just rebranded it, made it even better. So when you look at the major indexes, this is the NASDAQ, and you can just kind of see this is sort of early February, and it's up today, but you can just see net, it hasn't really gone anywhere. So there's been a lot of ups, there's been a lot of downs, there's been a lot of movement, but no progress. So that is kind of churny. On the other hand, it hasn't done anything wrong. This red line is just a 50-day moving average, and it's holding on to it, okay? And the bounce today is kind of bouncing where it, quote, needed to, of course. And honestly, the NASDAQ, well, at least among the bigger cap things, is the weakest. So the S&P 500, this was that kind of ugly reversal yesterday. It looks like the Fed might not cut in June. Who knows if they cut this year because things are too good, so to speak, which can be bad in the market. But at this point, the S&P 500 is right at the 25-day moving average. Obviously, we come in later today or next week and boom, boom, boom. It's a different intermediate term story. But, you could have said that anytime in the last 5 months too. Okay, so far, so good on that. And just running through the major indexes, New York Composite, 25-day moving average. Small caps and mid caps, of course, still weaker. Small caps have been unable to get going. But no real change in character. It's not like they're ripping lower. They're just kind of doing what they've been doing, which is not participating. I'm not trying to make that sound good, but it's the way it's been, so it's not really a change. And the mid caps actually had picked up, but again, 25-day moving average. So top-down perspective, most of the evidence remains positive, so you don't want to forget that and get too close to the market on these reversal days, up or down. Just I think overall you want to be leaning bullish, okay? I'm just going to run through kind of a bunch of charts because there's a bunch of stuff on my mind I didn't talk to you last week. So first is interest rates. I think more important is what the Fed's doing. The market's kind of cluing off that more. But if you do look at Treasury rates, this is the 10-year note. It's kind of threatening. It did hit, and it's sort of threatening. I don't want to call it a breakout, but highest level since early December, say, on the interest rate side. Same thing with a 5-year note. Same sort of, you can just see it's testing, going back, I don't know, whatever. Yeah, this is about Thanksgiving. So a few month high. So obviously if this accelerates, probably not the best for the market, but let's just see how it plays out. But interest rates, again, they were the tail that wagged the dog for the last couple of years, and they continue to be important. They're not all important, but they're important there. So just keep an eye on them. I do keep a distant eye on it. It's not an official indicator, but you can't ignore it either, okay? One positive, just running through things, XLP, which is the consumer staples. If there was worries about, the Fed is going to sink things in recession, you would expect money to pour into defensive stuff when the market wobbles. But we really haven't seen it. It had this nice uptrend. If anything, the XLP is kind of leading the way. I don't want to say leading the way lower, but it's weaker than the major indexes and even some of the growth stuff out there, okay? But a little bit below the 50-day line here. I don't think this is adjusted for dividends, so maybe it's right at the 50-day line. But either way, it's actually, you can just see relative to the market down here, it's pretty much hitting new lows, every couple of days here more recently, okay? Conversely, you have, well, I won't say conversely, but again, this is the IBD 50 index. It's probably up a little bit as I record this today. But again, you kind of have the same pattern you're seeing in the NASDAQ, just a lot more stalling and stuff like that. Okay, so you just kind of have this in-between situation where it's, if you weren't paying attention except every week and you had just some sort of mechanical system that said, alert me if, the market or key stocks break the 50-day line, you really wouldn't be doing anything. You're just kind of consolidating here. At the same time, having seen a bunch of these rallies kind of run into selling, 1 or 2 day bouts of selling the last couple of months, you just want to have your plan in place in case things break. That's all, okay? I mean, I'm not saying if things break, you got to be 75% in cash, maybe somebody who wants to be, but I'm just saying there are some names that have had big runs, and these things could pull back 15, 20, 25% if the market really pulled in, over time. So you just want to have your plan in place depending on what to do. For us, the things that we have good profits in, that have great stories, that have been leaders the whole time, we've taken partial profits, and we're probably going to try to ride through a correction unless, it really turns abnormal in those names, thinking that they can go higher down the road. Some other names we either don't have cushion in or, they're a little bit more, not the best. I mean, they're great stories, but they're not probably as long lasting. They're not really true market leaders. They don't seem like, so we might be quicker on the trigger with those. Again, if the selling persists, okay? Now, in terms of buying, there's a bunch of different ways to look at it. I kind of grouped this into 4 on my notes here, 4 different things, okay? So one is just strong names, okay? This is AppLovin, we've talked about before. They actually had announced sort of a random deal with a private company, but they're actually kind of putting their marketing platform kind of out for sale, not to sale like to sell, but for other people to use, which could open up a big opportunity. So anyway, the stock hit basically new closing highs this week. It could close higher today. We'll see how it goes, but good volume. Obviously, new RP peak. So this is a name, whether you want to chase it or not, but just overall looking for strength, okay? Micron Technology in the chip sector, obviously getting wobbled around here the last few days, but followed through nicely on this gap, obviously had the volume. You can just see on the weekly chart, definitely kind of a change in character on the upside, new, coming out of here, new highs easily. But that's definitely one to watch. That's holding up pretty well, all things considered here, even when the NASDAQ stumbles. Vertiv, I wanted to mention, VRT. This is very impressive. A lot of AI stocks have been the ones that have, like even NVIDIA, it doesn't look bad, but you can see, ever since a month ago, it's been, down, up, down. It's been kind of consolidating here. VRT is kind of a AI play. And it's one of the few that hasn't really budged at all. I mean, every time they hit it, it's getting supported. Yes, it was ugly yesterday, but it's back up as I record this today. So, I mean, it's basically right near new closing highs. We'll see how it goes, but so far so good on VRT. And just there are some in the medical field. This is NTRA. I've been mentioning this. It was in top 10 recently, but it looked kind of sick actually at the market lows, but completely changed character. And then you had this nice earnings gap month and a half ago, call it, something like that. And it's just been sort of chopping. Again, not a lot of net progress since then, but recently held the 25-day line and actually, popping the new highs today, or at least new, multi-year highs, year or two highs, which is pretty good for NTRA, okay? So there are still a lot of strong stocks, okay? Then there's potential, what I call PBRs, not the beer, but pullback resumption patterns, or just, pullback patterns. So this is Robinhood. Mentioned this before, Hood, HOOD, obviously up a million weeks in a row. Actually, how many is that? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, that's pretty, I actually didn't have that in my notes. That's pretty good. So 10 weeks up in a row, big volume. They do report a monthly metric thing that's probably coming out next week. Who knows? But it tends to move the stock a little bit. So down this week, obviously, but you can just see so far on the daily chart, it's only been a few days, so this could easily digest further, but so far just down to the 25-day line. I'm not saying buy it here or wait for it. It's up to you, but just in general, so far this looks like maybe the beginning of or in the middle of sort of a very normal first pullback, basically, after getting going, okay? Hims and hers, we'll see. This has been a little bit sharper, but, we've mentioned this, HIMS. I love the story, huge breakout, lower priced. But big run here. Now it's pulled back 2 weeks. You can see on the weekly chart, it doesn't look crazy. There has been a little volume this week, both up and down. You can see the last couple days. So we'll see. I mean, if this is one where maybe if it keeps dripping lower, you just kind of avoid it. But if it can hold up here and start to, reverse higher, and of course the market doesn't, implode, which would, I'm sure, probably drag something like this down. But so far, my point is it's the normal pullback. Let's see how it goes here. It would probably be good if it held up around here, okay? And then Novo Nordisk, we'll see. So, I mean, these things are not, Novo and Lilly are not in the first inning of their runs. They've had big runs the last year or two. But, of course, the stories are great. It had this tight area back here, almost kind of this multi-month sort of choppy consolidation, and then exploded higher. And now it is down 4 weeks in a row. But you can see volume's very light on the weekly chart, and it's down to the 50-day line. Again, this might be one where you want to nibble here, tight stop. Maybe you wait for a resumption to buy because, maybe it doesn't resume. But again, the reason I'm mentioning it is just overall nice uptrend, leading stock. A little long on the tooth in the pullback, 4 weeks at this point, but not doing anything abnormal, mostly low volume. So pretty good setup there, okay? Then you have some names that have pulled back. Maybe they've kind of steadied themselves and they look like they're near support. So this is Taiwan Semi. The breakout here was in mid-January, so the market can do, the stock can do whatever the hell it wants to do. But, from mid-January to early March is not exactly some prolonged, everybody already got in sort of thing. So it did have a big reversal. It's pulled back, but you can see it's starting to kind of calm down. Yesterday was a, wrench there, but monkey wrench. But we'll see how it goes. Still hanging around the 25-day line. Just on the weekly chart, it just looks a little bit, you can just see here, it had this base. Weekly charts tend to give you better perspective just because you're taking out all these whippy things. But, nice accumulation here, tightening up here, still above the 10-week line. So, no advice, but just in there. ASML also in the chip space, sort of same thing. Again, on the weekly chart, the big clue here was this, I think that was like 10-year, the heaviest weekly volume in like 10 years. Ran up for 5, 6, 7 weeks, and now it's been chilling out as the 10 weeks caught up. Airbnb, this is not, I keep an eye on this. So the RP line, this blue line, this is the stock relative to the S&P 500. Up is good, down is bad, So it's not really been outperforming it, but the stock has been kind of moving higher recently. You can see kind of in this persistent trend, and it's kind of trying to reach here. And you just have this kind of low volume pullback into the 50-day line, same sort of thing. And then last in this little section is AXON Enterprises, which I feel like I've mentioned AXON, once every 3 months for the last few years or whatever. But the stock, it did perform well the last few months, and then it had this nice earnings move. The stock is usually not something to chase. Usually it does kind of go up and pull back, just its character. But after this big earnings move, and, it's just kind of treaded water here. Obviously the moving averages are catching up. So it just looks like a proper pattern in there. It can be a little herky-jerky trading-wise, but AXON's one to watch. And then you have I could list a bunch of them, but these are what I would call potential PBRs, so potential pullbacks. So this is Valero Energy. The refiners are strong. I don't know. These things, when they move, they can move. So I've actually missed a few. Sorry, my phone's beeping. I've actually missed a few of these in top 10, just trying to look for a little bit of a pullback, and they don't pull back. So I've missed a couple of them. But with that said, so maybe it just ramps. But my guess is at some point you're going to get a pullback. Now, maybe these things totally pull back and oil falls $8 for whatever reason, and boom, and you don't want anything to do with them. But if you check back in a week or two or three, and you have some of those pullbacks like we saw in some of those stocks earlier, and it's kind of a normal pullback, the 25-day line catches up or whatever, just very strong stocks that maybe you could play on weakness. Gold obviously looks pretty good. This is Agnico Eagle, AEM. It still has some resistance here, but it looks like it's basically coming out to multi-year highs here. Obviously, it's going to be tied to the price of gold. GDX is just your general gold, ETF that has most of the big ones. GDXJ is the junior ones, but obviously it's still only a few weeks up, which you can look at as good or bad. Maybe the trend isn't quite established there, or you could look at it like it's early on, so we'll see how that goes, okay? And we're even seeing some, like, this is kind of out of nowhere, but this is sort of some of these shipping names. So this is Scorpio Tankers. Again, the RP line's not exactly there, but just setup-wise, this is STNG. It's obviously been generally going up, right? And then it hit some turbulence here in January, consolidated, but really hasn't done anything wrong. Broke the 50-day for a day, bounced up, just kind of tightening up here. So we're starting to see some of that, even like Starbulk, SBLK, same sort of thing, where it's not exactly like the most powerful thing in the world. Some of these are dividend plays too, but been trending higher and just sort of tightening up. So some of these commodities still look in favor. Obviously oil and stuff looks good with FANG and Valero and stuff like that. So if you do get a pullback in some of these, it could be interesting, okay? Full disclosure, we took some partial profits in FANG in top 10 today, but in general, if it did pull back, it could be worthwhile. So back to the market, I think it's just, I hate to come on a video and just say, hey, we'll see, but I think it really is about being flexible here. It's not like we're just getting going and, hey, anything can happen, but odds really favor, we're gonna go higher. These look like the leaders, let's put some money to work. It's also not like we've seen some huge selling in the leaders, big volume. We've seen these 5 stocks break down. You probably want to pull in your horns, trim your sails, whatever analogy you want to use. It's kind of right in the middle there where you just have this sort of period of no progress here, still holding the 50-day and the indexes. A lot of individual stocks doing the same thing too. And let's just see if they can really rip higher from here. Maybe yesterday was sort of the final interest rate driven, fear shakeout. And then we can ramp higher for a few weeks anyway and see how it goes. Or maybe, there's going to be more selling on strength and we start to see some of those breakdowns. So just have your plan in place. For now, though, I would definitely tend to lean bullish, but more just be prepared for whatever happens, which we'll cover again next week, okay? That's enough time for today. Thanks for listening. As always, come by again next week, like I said, for another Cabot Weekly Review.